Hi, welcome to this, my fifth update for my data from January 2019. In this session, I'd like to talk about the hurdle rate, the cost of capital. This is the end product of the discussion we started on risk in the last update. To understand what the cost of capital is for a company, let me use a structure that I find useful in both corporate finance and valuation. It's called a financial balance sheet. It looks like an accounting balance sheet, but rather than break assets down the way accountants do into fixed and financial and current assets, I'm going to break them down into assets in place, investments you've already made as a company, and growth assets, the value of investments I expect you to make in the future. It's a more general, more forward-looking way of thinking about the business of a company. On the other side of a financial balance sheet, there are only two items: debt and equity. There are only two ways you can fund a business. You can borrow the money or use your own money. That is going to give us the starting point for talking about cost of capital. Each of these claim holders, debt and equity, have a rate of return they require when they invest in your company. Let's take the equity investors. When equity investors invest in your company, they're not investing out of the goodness of their heart, I hope. They're investing because they expect to make money. The rate of return equity investors expect to make in your company, given what risk they see in your company, is your cost of equity. Now you're saying that's going to be really difficult to estimate. I agree, but you need that number because when you raise equity, you are promising these equity investors that expected return. So the cost of equity is the rate of return that equity investors demand for investing in the equity of your company and given their perception of risk in that equity. You see, what about lenders? Lenders have their own demands too. They set an interest rate on their debt. Now, if you think about what goes into that interest rate, it's their perception of how much default risk they see in your company. The greater they see as your chances of defaulting, the higher the interest rate you'll demand. That is the cost of debt. There's one little quirk in this process. The tax law in much of the world is tilted towards debt. In what sense? Interest expenses are tax deductible. The cost of debt, therefore, might get a tax benefit, and that tax benefit is going to be proportional to how high the marginal tax rate is. So cost of equity is the rate of return that equity investors demand for investing in your equity. The cost of debt is the interest rate that lenders to your firm long term demand for lending you money, adjusted for whatever tax benefits. You're saying, what's the cost of capital? The cost of capital is a weighted average of your cost of equity and your cost of debt. Weighted by what? How much of each you use. So you use 80% equity, 20% debt. Your cost of capital will have weights of 80 and 20. On the cost of equity and the cost of debt to come up with the cost of capital. That is a financial balance sheet perspective, the cost of capital. Now you're saying, where am I going to use it? Everywhere. I've described the cost of capital as the Swiss Army knife of finance because it shows up in so many different places. In corporate finance, it is your opportunity cost, the hurdle rate used to decide whether to invest in a business or not. In your capital structure, it's an optimizing tool for you to decide what the right mix of debt and equity for your company is. In your valuation, it's a discount rate you use to come up with the value of your company. So it's in corporate finance as an opportunity cost used to value companies. It's in corporate finance as a hurdle rate to decide on projects. It's in capital structure as an optimizing tool. It's perhaps because it's used in so many different places that cost of capital is much misunderstood and much misused. So in this session, I'd like to focus in on what the cost of capital is, how to measure it, and perhaps make some suggestions to make sure it doesn't run away from you. When you look at the cost of capital, it is the only place in finance where all your risks go to rest. So every risk you think about has to be in the cost of capital. And when I break the cost of capital down, every piece of the cost of capital has a responsibility, a risk to convey. So what I've done in this page is actually broken down the cost of capital, the cost of equity, and the cost of debt, and then broken down each into its ingredients. For instance, to get the cost of equity for a company, I start with the risk-free rate. I measure the risk in the equity by looking at the risk added to a portfolio, and I'm going to use beta as my stand-in for that. And then I multiply that beta by the price of risk in the equity market, which is the equity risk premium. Risk-free rate plus beta times risk premium is my cost of equity. To get to my cost of debt, I start with the same risk-free rate. That risk-free rate is the same risk-free rate, and I use my cost of equity. I add to that a default spread. I adjust for whatever tax benefits I get, but the default spread becomes my way of showing the risk in my debt. And I weight the cost of equity and the cost of debt by their relative proportions. Now you're saying, where do my risks show? I'm going to talk about 4 different risks in this session. I'm going to start with business risk. You're a steel company, you're exposed to risk of being in the steel business. You're a retail company, you're exposed to risk of being in the retail business. Business risk shows up in your unlevered beta. To get to a beta for a company, I'm going to start out with the beta of the business. That's where your business risk will show up in the beta. It's not going to show up in the risk-free rate. It should not show up in the equity risk premium. It'll show up only indirectly in the default spread. So the business risk shows up primarily and perhaps only in the unlevered beta, the beta from which I'm going to build up the beta for your company. If you have borrowed money, financial leverage risk shows up in a couple of places. First, it shows up in your beta by scaling up the beta of your business. This is called levering a beta. I'll describe the process in a couple of minutes. But the levered beta for a company reflects the business beta, the unlevered beta, plus the added effect of the leverage that pushes up your beta. The leverage effect also shows up in your default spread. After all, the more you borrow, the greater the chance you will default. So the default spread, it'll show up in the default spread as well. So financial leverage risk shows up in the levering of your unlevered beta and in your default spread. Well, the third risk I want to talk about is country risk. Not all countries are equally easy or equally difficult to operate in. So the countries you operate in will affect your cost of capital. If you operate in risky countries, you should have a higher cost of capital. The country risk, at least in my computation, show up in only one place. They show up in your equity risk premium. If you operate in a lot of risky countries, notice what I said. You operate in a lot of risky countries, not incorporate. Doesn't matter where you're incorporated, your equity risk premium should be higher. I'm not going to push up your beta. I'm not going to push up your risk-free rate. I'm not going to push up your default spread. It's your equity risk premium that's going to carry that weight. Finally, let's talk about currency. I'm not even sure currency is a risk that you're incorporating, but the choice you make will affect your cost of capital. It'll affect it primarily or perhaps only in the risk-free rate. If you pick a high inflation currency, you will have a higher risk-free rate, which will push up both your cost of equity and cost of debt. So in summary, your business risk shows up in your beta, your leverage risk shows up in the levering of your beta and your default spread, your country risk shows up in the equity risk premium, your currency choice shows up in your risk-free rate. Everything has a place. My problem with people who mix in risks in multiple places, you end up double counting or triple counting risk or sometimes missing risk. So let's take each of those 4 risks and talk a little bit about why they matter and how they show up. When you look at the risk of equity in a company, of course, the business that the company is in matters. Now, how much risk you perceive in the company, though, will depend on how diversified you are as an investor. Remember in the last session, we talked about how the risk you see in equity can be very different if you put all your money in a particular company or sector or if you spread it out. Once you start spreading your money out across companies and different businesses, the risk of a business becomes a risk it adds on to a portfolio. And we measure that risk with the beta. To get to the beta of a company, there are 2 ways you can go about it. One is you can listen to your old finance professor and run a regression of the returns on your stock against returns on a market index, and the slope of the line is the beta. That's the way I was taught betas. I'm sure that's the way you were taught betas. It's a terrible way to think about betas. First, it's one slice of history. Strange things can happen to companies during that slice, making your beta a strange number. Second, that beta comes with noise, a standard error. Remember your statistics. You get a range for the beta, not a precise estimate. So you're saying, what's the alternative? You could build up to a beta for your company by looking at what business or businesses it's in and finding the beta for that business or businesses and then taking a weighted average. You see, what are you talking about? Here's the process by which I estimate betas for individual businesses. I collect every publicly traded company in the world, and that's the data set we're looking at right now, 42,000 plus companies. I break them down into businesses and I estimate a beta for each business by taking an average, a simple average of the betas of all of the companies in the business. That simple average beta is an average regression beta for that business, steel, chemicals, retail. That beta, of course, is a function of both the business and the leverage in that business, and it's also affected by the cash that these companies hold. So I make 2 cleaning up changes. First, I unlever the beta. I take out the effect of debt in that business. Second, I adjust for the fact that cash has a beta close to 0. The ending beta is what I call a beta unlevered and adjusted for cash. You will see this in the data set that I'm linking up to this session, but you will see an unlevered beta corrected for cash. It's often called a pure play beta for just the business. So if you're a steel company and that's all you're in the steel business, you can use the unlevered beta corrected for cash for steel as the beta of the steel business. Of course, the fact that your company has more debt and cash will come into the process somewhere, but you have a starting point. So the reason I estimate betas by business is to allow myself to do this. Now, I do this for companies globally. I do it for sub-regions. I do the US, I do emerging markets, Europe. I even do it for individual countries like India and China, but I don't break it down for every country because you often don't have enough companies in most countries to be able to do this. Now let's move on. Let's assume now that you've got the betas for individual businesses. How do you get the beta for a company? To get from business betas to the beta of a company, there are two things you need. The first is you need the breakdown of what businesses the company is in. And that should be relatively simple to get from an annual report, from financial statements, from what you know about the company. Second part, you need weights for each of these businesses. Those weights are supposed to be value weights. In other words, you need the value of each business to get a weighted average, but often that's going to be tough to do. You might get revenues by business, operating income by business, but getting value by business is a tough challenge. So if you're in a hurry, I would use revenue weights or even operating income weights. But if you're not, I have a suggestion. Take the revenues of the operating income and estimate a value for each business. After all, you know what publicly traded companies in that business trade for. They trade at 2 times revenues, multiply by revenues in that business by 2. Take the weighted average of the betas of the different businesses. You have a beta for your company. Now let's move to the second risk I want to talk about, which is financial leverage. Let's start with a basic proposition. You can run your company with no debt if you choose to. You borrow money for one of two reasons. Either because you have little or no access to equity and you're forced to borrow money. The second is you have access to equity, but you believe that borrowing money is going to work to your advantage because it's going to lower your cost of capital, rightly or wrongly. So when you borrow money, you affect your cost of capital. And you affect it in 3 different places. First, of course, in that mix of debt and equity. The debt ratio that you use will be a function of how much debt you have in your cost of capital. The second is when you borrow money, as I said, your beta will be affected. To show you the mechanics of how the beta is affected, remember that unlevered beta broken down by business that you got by taking a weighted average? Take that unlevered beta. When you borrow money, that unlevered beta is going to get scaled up when you look at your equity. It's going to get levered up. The amount of the effect is going to be a function of how much you have in debt, and I'm going to measure how much you have in debt with the debt to equity ratio. So for every dollar of equity in market value terms, how much debt you take. Everything is in market value terms. And of course, since there's a tax benefit to interest, I'm going to give you a partial protection against the debt you've taken on. But in effect, here's what happens. You have your unlevered beta, and as you borrow more money, your debt to equity ratio goes up. And as your debt to equity ratio goes up, your levered beta goes up. The third effect, of course, is in the cost of debt. As you borrow more money, your default spread will increase. You are getting yourself more exposed to default risk. That default spread goes up, your cost of debt goes up. And of course, you get a tax benefit. So I'm going to multiply the cost of debt by 1 minus the tax rate. A caveat on the tax benefit. To get it, you have to be making money. So if you borrow so much money that you end up losing money, you start to lose your tax benefits as well. Third, let's talk about country risk. Let's start with the basic proposition. Some countries are riskier to operate in than others. That it follows, at least from a common sense perspective, then that I think that your cost of capital should be higher if you operate in risky countries. That is not a consensus view. There are some people who believe that country risk is not a factor. And the reason they do it is actually based on a logic of diversification, which is if you're in lots of different countries, country risk can be diversified away. 30 years ago, that probably was true because the correlation across countries was low. Now, as countries have become more correlated, I think it's not debatable that there is country risk, and it's your job, if you operate in risky countries, to bring it into your cost of capital. If you decide to go down this road, you need measures of country risk, and there are 3 broad measures. The first is about 150 countries have sovereign ratings. Ratings agencies like Moody's and Fitch and S&P rate them. And if you believe those ratings or buy into those ratings go with default spread. So the first approach is to use a sovereign rating and a default spread. The second approach is to get a market estimate of the default spread from the sovereign CDS market, the credit default swap market. Think of it as a market measure of the default spread. Both these measures are default spreads. I use a variant by where I start with the default spread and I scale it up for the fact that equity, which is what we're looking at here, is riskier than debt. I come up with a country risk premium. So if your default spread is 2% and equity is 1.2 times more risky than debt, in this case the government bond, 1.2 times 2% is 2.4%. So let me describe how this process worked in January 2019. I don't know whether you remember from the first update I did this year, I computed an implied equity risk premium for the US, the S&P 500 of 5.96%. I make that my equity risk premium for a mature market and I apply it to every mature market. You might say, well, how do you know which markets are mature? Very simple. I use a AAA rating as a proxy for a mature market. I give every AAA country a 5.96% equity risk premium. If you're not AAA rated, I look at your rating and I come up with a default spread based on that rating. Then I multiply the default spread by a scaling number, and the scaling number that I used in January 2019 looked at two standard deviations. The standard deviation in equities, and I looked across all emerging market equities, an index of emerging market equities to compute that, and a standard deviation in emerging market bonds. The scaling number in January 2019 was 1.23. So in other words, if your default spread is 2%, I multiply by 1.23, I come up with a country risk premium of 2.46%. I add the 2.46% to the US premium, 5.96%, I get 8.42%. That becomes my risk premium for your country. And I do this for every country. I even bring in countries for which I could not get a sovereign rating. These are usually frontier markets like Syria and North Korea. I use a score called the Political Risk Services score. It's a country risk score. I look for other countries with similar scores that have ratings and I attach a country risk premium. By the time I'm done, I have a country risk premium for about 175 countries. In this picture, I've captured most of the countries for which I have risk premiums. If you want a fuller list, you should visit my website and download the entire Excel spreadsheet. But you can see by region first how much of a difference there is across regions. Some parts of the world are riskier than others, but more importantly, within each region, notice how much variation there is in country risk. In Latin America and Asia, you're saying, how did you compute the risk premium for the region? I took a weighted average of the risk premiums of the countries in that region, weighted by the GDP of each country. I now have a picture that I can use to come up with an equity risk premium for a company. Incidentally, the way I will compute an equity risk premium for a company is I take a weighted average of the countries that the company operates in, or the regions of the world it operates in. So just as beta is a weighted average of the businesses you operate in, the equity risk premium is a weighted average of the countries you operate in. Finally, let's talk about currencies. For a lot of people, countries and currencies get mixed up, and they shouldn't be. It is true that most risky countries have volatile currencies, but that's neither here nor there. Because you can value a company in any currency. Currency is a choice. And here's why the choice matters. Currencies convey inflation. You cannot make a risky country into a safe one by just doing everything in US dollars. All that currency does is bring in a different expectation of inflation. Does it affect your discount rate and your cost of capital? Absolutely. Picking a currency with higher inflation will give you a higher cost of capital. But guess what else is going to change? When you do your cash flows and your growth rates, they have to be in the same currency, and the same higher inflation will now show up in your cash flows. If you work correctly with currencies, your valuations and investments should be currency invariant. So when you think about currencies and how they show up in your cost of capital, there are two ways you can do it. One is by coming up with a risk-free rate in that currency. I tried to do this, and the reason I have to try to do it is it's not that easy. Because while you might use a government bond rate as a risk-free rate in US dollars or euros, be very careful because not all governments are default-free. So when I look at the risk-free rate in Indonesian rupiah or Indian rupees or Brazilian reais, I start with the government bond rate, but then I subtract out the default spread that I talked about earlier when we talked about country risk. I subtract out the default spread to come up with a risk-free rate in different currencies. So in this approach, you're starting with the government bond rate. It works as long as the government bond rate yields a reliable number. So let's talk about what to do if the government bond rate is not a reliable number, or you cannot find a government bond rate, which is the case in many currencies. You can go back to basics. Remember, the only reason that currency matters is because each currency carries a different measure of expected inflation embedded in it. If you can adjust for the differential inflation, you should be able to convert a cost of capital in any currency to any other. This is a huge plus, because here's all you need to do to compute a cost of capital then in a currency where you cannot get a risk-free rate. Estimate a cost of capital in a currency that you can get that risk-free rate. For me, the most comfortable currency to work with is the US dollar. So I compute the cost of capital for the company in US dollars. Now let's assume I want to convert that cost of capital into a cost of capital in Egyptian pounds. I need two numbers. I need an expected inflation in Egyptian pounds and an expected inflation in US dollars. If I can get that expected inflation and I'm in a hurry, I can just add that differential inflation to my US dollar cost of capital. So as an example, let's assume your cost of capital in US dollar terms for an Egyptian company is 12%. The inflation rate in Egypt is expected to be 15%, and the inflation rate in the US dollar is 2%. You take that extra 13% inflation, add it onto your 12% cost of capital, you have a 25% cost of capital. That's if you're in a hurry. If you have the time, here's all you need to do. Take 1 plus your US dollar cost of capital. An example that I just gave you, that'd be 1.12. Take 1 plus the inflation rate in Egypt, which would be 1.15. Divide that by 1 plus the inflation rate in US dollars, 1.02. If you bring it all together, I know it's a lot of numbers in your head, and you work it through, you come up with a cost of capital in US dollar terms of 26.27%. Higher than the 25% approximation, but it brings in the differential inflation. So business risk, country risk, currency risk, leverage risk, it's all in your cost of capital. We close this session with a few propositions that I think are worth remembering when you use your cost of capital as a hurdle rate. Remember, a hurdle rate is an opportunity cost. It's the rate of return you can make on investments of equivalent risk out there. It's not a cost of raising money. I know the words cost of capital suggest this is what it's costing you to raise money, but it's less about funding costs and more about the risk of the investment you're looking at. This is why when you value a target firm in an acquisition, you don't use your cost of capital as an acquiring firm, even though you've raised the capital. Use a cost of capital that reflects the risk of the target firm and the debt that that target firm can carry. The second proposition, it's a related one. Lots of companies have company-wide hurdle rates, a cost of capital used across the board. That doesn't make any sense. It's both misleading and dangerous, because to the extent that a company is in many businesses and in many countries, you can already see why you cannot have one hurdle rate that applies across the company. How can GE as a company have one hurdle rate but it's in 6 different businesses and 50 different countries? You need hurdle rates that incorporate the business you're investing in and the country you're investing in. So if you ask me to come up with a cost of cap for a project, I need to know in what business and what country. So company-wide hurdle rates make no sense. Third, remember that currency is a choice, but it's a choice that should not affect your outcomes. Put differently, if you find that a project is a bad project and you've done everything in US dollar terms, just switching currencies and doing everything in Riyal should not make it into a good project. If it does, something's gone wrong somewhere, because essentially you've been inconsistent about inflation somewhere in your analysis. So if you do it right, currency should not affect your outcome. Your analysis should be currency invariant. Proposition 4, your cost of capital cannot be insulated from the market. I know there are people out there, CFOs and investors, who don't trust markets. I share your mistrust of what markets do on a day-to-day basis, but you cannot insulate your cost of capital from the market. Why? Because there are inputs into your cost of capital where you have to be a price taker. Take the risk-free rate. You and I can sit here and debate about what the right risk-free rate should be or what a normalized T-bond rate should be, but that's irrelevant. If the risk-free rate today is 2%, I have to build that into my cost of capital. Because if I build in my normalized version of the cost of capital, let's say it's 4%, and I come up with a higher cost of capital and I reject projects, what am I going to do with that money? I'm not going to be able to invest it at my hypothetical 4%. Similarly, if the price of risk goes up in the market, it's your job to incorporate it. Your cost of capital cannot be insulated from the market. And finally, when you look at the cost of capital for a company, a hurdle rate for a company, use perspective. Think about whether that number is a high or a low number. And the simplest way I have of gaining perspective is to look at what cost of capital look like around the globe. So it started January 2019. I computed cost of capital for all 42,000 plus companies in my sample. This is the distribution of cost of capital across the 42,000 companies. I've also reported the distribution of cost of capital across companies, not just globally, but by sub-region. So the way I would use this is if you came to me and told me your cost of capital is 15%, I'm going to say, well, that sounds high. Why does it sound high? Because the 90th percentile for US dollar, first, when you say it's 15% in US dollar terms, the 90th percentile for the US dollar cost of capital for global companies is 13%. You must be in the 98th or the 99th percentile to have a 15% cost of capital. Having perspective will let you figure out when companies are playing games with hurdle rates. So my parting advice to you is, when you go back to work at whatever company you work at and you're given a hurdle rate, be a disruptor, be a pain in the neck. Ask why. Where did this number come from? Often the answer you will get is, I have no idea. It's the number we've been using forever. You cannot do that in corporate finance and investment analysis. You have to have perspective. You have to have a reason for what you're doing. Thank you very much for listening.